This is the third video in our series on technical analysis. In this video, I'll walk you through support, resistance, and candlesticks patterns. But if you've read my book, you must have noticed my style of teaching is I don't like to go too much into theory. I like to focus more on the application because I feel like if you go too much into theory about how things work without knowing how you can apply them, you kind of lose interest. So, keeping that in mind, in this video, I'll just focus on support, resistance, and candlesticks and how you can apply it to finding trades for the 25K trading methodology. Now, I keep talking about candles in all my charts. So, I think it's important for me to just give you a really brief overview of how to read candles. Candles represent the movement in an equities price in the time frame you're looking at. So let's take the example of the time frame that I look at, which is a 3 month daily chart. In that time frame, one candle would represent that day's movement in a stock's price. So let me switch to think or swim here. So this is the daily movement in that stock price. This is another day. This is another day. If you're looking at a different time frame, let's switch to a daily 5 minute chart, right? So this is Tesla on this day being plotted every 5 minutes. You can see the timings here: 11 o'clock, 11:50, 11:30. So one candle represents every 5 minutes. So depending on whichever time frame you're looking at, that's what the candle represents. Now, how do you read a candle? It's really easy to read a candlestick. So let's talk about a bullish candlestick. So the way the candlestick works is you have an open price where it shows you the open price, and then let's say we're talking about Apple stock. Apple is trading, let's pretend it's trading at 100. So today morning the market opens. This price will represent that 100. Maybe during the daytime, the let's switch to this green candle since we're talking about bullish candles, right? So during the daytime, maybe it will go from 100 to 110. That would be the high of the day. And then maybe it drops during the same day. From 110, it drops to 95. That's the low of the day. So it opens here, goes up to the high, goes down to the low of the day, and then finally ends up closing at 105. So that's how the candle is constructed. If it's a green candle, these 2 points represent the low and high, and the body, this is called the body of the candle, represents the open and close price. So it's really simple. Now when you're looking on a down day, the bearish candle, the high and low, there is no difference. The top is the high, this is the low, but the bearish candle represents the open is here and the close is here. So that's how you read the candlesticks. Now there are many candlestick patterns. So these are also called Japanese candlestick patterns. So now since we're on the topic of candlesticks, I quickly want to draw your attention to an interesting candlestick pattern that I watch out for. So it's called a doji candlestick, and the definition of doji is it's a point in the market where the bulls and bears have reached a point of indecision and no one is in control. So you will notice that these dojis appear quite a bit at the top or bottom of trends. And since I do reversal trades, I like to keep an eye on this. Now, by itself, the doji doesn't give you a decisive trade idea, but if you use that in conjunction with your other indicators, support, resistance, and your other indicators, then I find it really helpful to just keep an eye on it. So a typical doji looks like this. So what you'll notice is the candle looks kind of like a plus sign. So the let's say Apple opened here at this point at $100. The same day it went all the way up to 105, then it went all the way down to 95, and finally ended up closing at $100 at the same point. So you'll notice that the sellers and buyers, nobody's in control here. It's kind of compressed. So these patterns will show up at the points where usually reversals happen. So I just pulled up this chart of Facebook. And one thing about dojis is, although they show possible signs of reversal, but you have to pay attention to when the doji is appearing and you have to combine them with your other indicators. So in this example, Facebook is on a downtrend, and at the bottom of this downtrend, you'll see doji starts appearing. Actually, doji starts appearing here too. So would you take this doji or this doji as a sign of reversal? So a simple trick that I use is I pay attention to my other indicators. So is RSI showing you that the stock is about to go up? So if you look at this doji, RSI is showing you nothing. Whereas if you start seeing this doji, the RSI at the same point is beginning to turn up, and RSI was in the oversold area and it now is beginning to turn up. So the way I use dojis is, when I see doji start appearing the at the height or bottom of a trend, I'll start paying attention to other indicators. So in this case, doji appeared here. On this day, RSI is showing me nothing. But the next day, you'll see a green candle and the RSI is beginning to go up. So this doji I'll pay attention to take my trades. But if a doji appears like this, where the other indicators are not telling you this anything, then you ignore it. Also, if a doji appears right in the of uh, middle of a trend, so for example, this it's not a price extreme. It's right in the middle. It's not too high, not too low. It's right in the middle. This is right in the middle. So this is right in the middle. So all these dojis, you just simply ignore them. The only dojis you should pay attention to is which occur at the top or bottom of a trend, and they when the doji occurs, it's followed through by other indicators supporting that story. So in this case, the this is the bottom of the trend, went all the way up to the upper channel of the Bollinger Bands, and at this point, there's a doji. So at what you need to do is you start observing from that point on any signs of reversal. So if you go forward a few days, RSI is beginning to point down. So you could have taken a trade somewhere over here. Uh, Again, dojis on their own do not generate any kind of signals. So I personally just use doji as an indication of a possible reversal coming. But the reversal of the trend has to be confirmed by watching other indicators. You must have watched the first video in this series where I did talk about support and resistance, and I explained the psychology behind support and resistance level in that video. So since I've already explained that, in this video we'll just go into the application of support and resistance. So support and resistance are just predetermined levels of the price of a security at which it's thought that the price will tend to stop and reverse. So that's simple definition. So in this example of a hypothetical stock, you'll notice that the stock is going sideways. It's in a consolidation pattern. So you will notice that the stock, although it's in consolidation and moving sideways, it still keeps bouncing up and down between these two imaginary lines. These lines are support and resistance. So you will also notice that if the stock is trending, So the previous example was a consolidation phase where the stock was going sideways, but support and resistance come into play even when the stock is trending. Whether it's going up or down, it doesn't matter. So in this example, you will see the stock is going up in a channel, so it's in an uptrend, but the the price is still bouncing between these two imaginary lines of support and resistance. So support and resistance come into play irrespective of how the equity is trending. So now let's quickly jump into think or swim and show you how we can draw support and resistance and how we can apply it. So we are in think or swim right now, and I have removed all my indicators and all that other stuff so that I can explain this clearly to you. So this is the really basic chart of 3M or triple M, and we actually put on a trade on triple M last Friday, which was, what was the date last Friday? It was 15th May. So triple M had earnings on this day, and what we did was, you must have noticed that I do two kinds of trades. So either I do mean reversion trades or I do earnings trades. But I don't I don't do earnings trades before earnings. So I avoid earnings like the plague because it's a binary event. So for example, on this day, it just happened that 3M had good earnings and the stock that shot up to the moon like crazy, but it could have also gone down like crazy. So because of the binary nature of the event, I totally avoid earnings. But that doesn't mean that you can't participate in earnings. So the way I participate in earnings is I do post earnings trades. So once that binary event has happened and the news has been digested into the market, then I look for trades on that particular equity. So let's let's switch back to the support and resistance on 3M, and I'll show you how I placed a trade last Friday on this using just simple support and resistance levels. So to draw support and resistance lines, it's super easy. There is no complicated science to it. All you have to do is, let me find a drawing tool. Let's pick a line. And what you need to do is to find support, in this case, just find a point where the equity is touching a line at multiple points. So I'll just start here. So let me draw this line. So now see how quickly I was able to draw a line, a support line on this. So the first rule of support and resistance is you shouldn't have to think twice when drawing a support or resistance line. It should be very obvious to you where the support is. And the way you determine that is any price point where the price of the equity is bouncing at that line back and forth at multiple touch points, that's where your support and resistance levels lie. So in this case, you will notice touch, 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 all these points, touch, touch, touch from the either from the top or the bottom. That's where your support is. So here the equity was coming down and then it went back up. Then it came down. So any point that the price is touching the line, that's your support. So that's one support line on this. Let's draw a few more. So let's try. This looks like a clear support line to me. I'm going to draw this line. Okay. So now, like I said, there is no rocket science to this. So you shouldn't try to make it more complicated than it is. So if the price is kind of, partially touching it, it doesn't matter. So don't try to be too obsessive about finding the exact line. Just This is just to give you an idea about where the support and resistance levels are for this stock. So I just drew this line. So you will notice that there is a touch point here, this long wick, it's almost touching it, touch point, touch point, touch point, touch points, touch point. So that's another support level. We can continue drawing more support levels. Let me just draw two more because I'm trying to explain a point here. How I take my post earning trades by simple support and resistance levels. So let's see where else can we find another level. So here, okay, I'm gonna draw a line right here. Okay, let's just stop right here. So as you can see, touch point, mini touch point. So that's another support level. You can, if you want, you can draw more. You can keep drawing it, but the key is the more points an equity is touching that line, the stronger that support level is. So if there is only one touch point, yes, that could be called a support, but it may not be as strong of a support. So let me just draw this last line here. So let's grab this and let's keep drawing a line. And the line is not exactly accurate, but yeah, this is another support level. So now having drawn these, what you'll notice first thing, the support and resistance level is the equity tends to bounce within those levels, up, down, and sometimes it breaks down a support. When the support is broken, it becomes resistance. So in this case, this you saw that this support has been broken. It went all the way down, then it bounced back up. But notice what happens now. This previous support is now a resistance. So it'll knock on that, but then it'll fall again. So that's how a support and resistance work. So the previous support, if broken, becomes resistance in the future. Now, how do I use these for a practical application? How do I find trades? So, as you know, when I do my mean reversion trades, I have my indicators, the ADX, RSI, Bollinger Bands, all that good stuff. But when it comes to post earnings, I don't use any indicators. I wouldn't call it an exact science. So you have to use some level of judgment, and the judgment comes with using support and resistance levels. Let's talk about support and resistance in context to a recent trade we placed in Tesla. That way you can relate to what I'm talking about. So first, this is the very basic chart of Tesla. Let's start drawing support lines here. So let me just choose a tool, line tool. And as I mentioned earlier, there is no rocket science in support and resistance. The support lines should be very obvious to you, and it should have multiple touching points. That's all there is to it. So let's start drawing a support line here. So you'll notice that this bar is touching it, this bar is touching it, this bar is almost crossing it. You don't have to be exact about drawing it. Don't worry if some bars are crossing it. As long as you have at least three or more points, price points, which are touching your support. So this is one support line. Let's draw another one somewhere over here. That looks like a very obvious support line to me. Okay. And then finally, let's draw another one just for practice somewhere over here. Okay. So I'll stop here. So now we have three support and resistance zones in Tesla. Now you will notice that each support and resistance zone is characterized by the price action moving back and forth in it, and finally at some point breaking out of it. Once it breaks out, it creates a new support. The previous resistance becomes new support, and then it forms a new resistance level, and then the price bounces in that until it finally breaks out of that, and the same phenomena keeps continuing. So now at this point it broke out of this. Now this is your new support. So let's talk in context of how I placed post earnings trades on Tesla by just observing support and resistance. I didn't use any fancy tools, no indicators, nothing, just support and resistance. So on this date, 4/29th, is when Tesla came out with their earnings. So the very next day, I'm guessing this happened after market close. So the next day, you see this huge spike in the price, went all the way to 870. So at this time, I started looking for a continuation trade. So as you may have noticed, and I've mentioned many times that uh, I don't participate in earnings. And by that, what I mean is if an earnings event is coming up, I don't put on any trades because the earnings event is a binary event. So, irrespective of if earnings come out good or bad, the market's reaction is unpredictable. So, this huge spike that you see on this day, it could have been down too. So, the spike could be here. So, it's almost like a gambling situation where you have 50-50 chance of winning or losing, and I just don't like those kind of situations, so I avoid earnings. But what I do is I instead of playing earnings, instead of playing pre-earnings trades, I place post-earnings trade, because what happens is after post-earnings, all the surprise news that happens on the earnings day has been digested, and when it gets digested, you see the reaction of the market, either it's up or down. And what happens is there is always an initial spike, and then as it gets assimilated and digested, that the earnings report, you will see a pullback. So whether it's up or down, if it's down, it will go up back way. If it's up, the pullback will happen this way. And that is the time when I'm actively looking for a trade. And the trade I'm looking for is always in the direction of the initial spike. So if the stock rocketed up after earnings, I would look for a continuation trade in that direction. If it dropped, I would look for a continuation trade, a bearish continuation trade. So in this case of Tesla, it went all the way up, $100 price movement, right? Next day, it dropped all the way here. So what I did was at this point, let me pull up this trade alert which I sent out on 4:30. It was a Tesla 770, 775 bull call spread, and I'm going to keep it here for your reference. So if you look at the chart, it was this date 4:30, and then I alerted about this trade somewhere over. The price at the time of this trade was 770, so somewhere over here. So it was basically that day Tesla touched the support line. That's where I placed this trade, and I did send this alert out. And I just, like eyeballed the support level. So my line could have been here. It doesn't matter. You don't have to be that finicky about where exactly your line is. So I put on this trade, and what happened was the very next day, Elon Musk came out with some kind of a tweet that Tesla price is too high, and then that dropped the stock like almost $100. So there was a support zone there, and then just observe what happened here. The stock dropped $100 on really no material news. So whenever a stock moves like that, on any kind of panic news like that, I don't even bother about it. So you may have noticed next day in our Discord group, many people were asking, should we close this trade? Should we close this trade? I was like, no, just leave it. We just put on this trade yesterday. Let's leave it and see how it plays out. Because I had a conviction that this drop is unwarranted. The, this drop happened only because of Elon Musk's tweet. That doesn't reflect any material news about the stock. So when this drop happened, it dropped all the way to the next support level. So if you see this line that I drew, it went all the way down here. In fact, I put on a I put did put on a trade in my other account, which I mentioned in the Discord group. I put on a huge trade at this point. But irrespective of that, what happened was the very next day the stock bounced back up, and now the previous support is became resistance on that day. So stock bounced back up from the support, went back up to the previous support, which is now resistance, and stopped there. That was the next day. The following day, it crossed through that support and rocketed up to the original price. This is where we traded, right? It went back up and it stopped at the next resistance. After that, what happened was it kind of bounced back between this price range, tries to cross that up, went back up, it crossed this, and then what you will notice is, let me pull up my second trade alert, which you'll find interesting. So on 514, I put out another trade alert for 775, 780 bull call spread. So on 514, which day is that? Somewhere around here. So this is the day when I alerted about a 775, 780 bull call spread. And the reason why I did that was my original conviction here. Remember, I put on this original trade here, 770, 775 Tesla bull call spread. After that, it dropped like a rock, but my conviction still holds. So now we get a second opportunity here, and that is when I alerted about the second trade. And as you will notice, it after that point it went back up and it has established a new support level. So this is a new support level. So as long as it bounces off this support level, we'll make 100% or 90% profit on this trade and this trade. So that's an example of how I use support and resistance to put on post earnings trades. I want to take another example of a trade we recently put on 3M, and this was also a post earnings trade. And this was slightly different than the Tesla trade I just showed you, but I just want to explain to you my thought process behind post earnings trade. Now, I just want to point out that you know the stock market is a very dynamic and fluid market. It's always changing. So there is always a level of judgment you need to apply when putting on trades, and that does come with experience. So this situation, every situation is different. So what we saw in Tesla is not the same with 3M, but I just want to point out the main points that I consider when putting on a post earnings trade. In this example, on 428, 3M came out with earnings and the stock spiked up. We had a big spike. Typically, based on what I've told in the past, what I would do is I'll wait for a pullback to the next support and then I'll put on a continuation trade, right? So since it was a bullish move on the earnings, I would want to get into a bullish trade at this point in the same direction of the post earnings movement. So in this case, what happened was this is the support. So do you think I would have taken a 155, 160 call spread here? This is a really nice support line. I could have. I could have done that because that's what I typically do. But I'll point out one more thing to you that when I'm waiting for this pullback in the market, uh, what I also pay attention to is the the candles on the following days should start shrinking. What that really means is that the momentum in this direction is losing strength. So huge candle here, slightly shorter, shorter, and then finally we have this candle called a doji candle. At this point, basically the sellers and buyers are balanced. Nobody is overpowering each other. So at this point, I would have definitely taken a trade, would be probably be 148, 152, 153 bull call spread. So I would have taken this trade for sure. Now in this case, just it just happened that I wasn't watching Triple M. It was one of our members who asked me about Triple M on this day, on 5:15, that Nishant, should we put on a trade on Triple M? And I quickly looked at the chart and I was like, oh wow, this looks a pretty interesting chart. I would have actually taken a trade right here. And let's put on a trade. So I would have taken a trade here. I would have taken a trade here, here, multiple points. And what happened after that? If you notice that it bounced off of this zone, and now we are trading somewhere over here. So if I had put on this trade here, we would still have been profitable as long as the stock expires above this point. So I thought that I would show you this example on what the thought process was behind this 3M trade. We did get lucky that we got a really low entry point, but as I explained, I don't want to pretend that I always know the perfect entry point for any trade. I could have taken this trade at multiple higher entry points, but that's another cool thing about debit spreads is that it doesn't matter how low you get into your trade. All that matters is that at expiration, does the stock expire above your short strike? As long as that happens, you still get to make your money. So this concludes this video about support, resistance, and how to use it to find post earnings trades. Hope you found this video useful, and if you have any questions, feel free to post comments below and I'll be happy to answer those.